Hello and welcome back to the channel. We're going to be doing another stock analysis today, and the stock that we're going to be covering in this video is PayPal. Ticker symbol PYPL. PayPal has been requested a few times on the channel. They're a stock that's always on my radar. It's never really selling cheap, but that is for good reason. They are a global fintech payments company, as you probably know, that probably was one of the biggest beneficiaries from the coronavirus pandemic and will have continued tailwinds due to the nature of their business and what is happening in the world today. They operate the best known digital payments platform in the world that enables merchants and consumers to make digital and mobile transactions anywhere in the world with ease. Its core product solutions are the PayPal platform, PayPal Credit, Venmo, Braintree, Zoom, iZettle, and Hyperwallet. It's a pretty simple yet brilliant business model where PayPal generates revenues through charging a fee on all payments and transactions that are done on the platform, and then interest on any credit lines given out or any assets held. They are essentially paid for facilitating the payment process, which is a very luxurious and asset-light business. The global payments industry is vast and dominated by a few big players such as Visa and MasterCard, but over the past few years, businesses with slightly more versatile platforms and solutions entered the market to really boost the digital age of payments and transactions. These companies include the likes of PayPal and Square, as well as some other smaller players that are on the come up too. On the face of it though, the market may seem very competitive, which it is, but this is a market with over $2 trillion in revenue on an annual basis, which is huge, meaning there is plenty of room for the likes of PayPal and others to claim a piece of the pie. And then add to that the fact that 50% of all global consumer-to-business payments were made using either cash or check back in 2018 to 2019. So 58% of the time, a physical method of payment was used. Even in the US, which is one of the most developed nations in the world, they still used cash or check or other physical methods 30% of the time. So that paves a significant and long runway for growth for the likes of PayPal, who is penetrating the payments industry with digital alternatives, which in my opinion will start to grow even further on from where they are now. And going by a Grand View research report, the global digital payments industry was valued at $58 billion in terms of sales volume in 2020 and is expected to grow at a compound annual rate of 19.4% up until 2028, which would have the market valued at around $240 billion by that period. So that's a 4x from its value today in just 7 or 8 years. And linking this back to PayPal, you can see how their revenue is segmented. So we've got 93% comes from transaction revenue, which, like I mentioned, is made from charging a fee for facilitating the payments on PayPal's platforms. The two twin engines that fuel the growth and fuel revenue in this segment are PayPal's active user accounts and then total payment volume from those accounts. And as we can see from the graph here, the total number of accounts that PayPal has been growing very consistently every single quarter since 2010. Not surprisingly, we see a jump in the number of accounts since the pandemic, and now that the growth curve is actually looking more linear than it ever has. So more people than ever before are opening PayPal accounts. But maybe what's even more impressive is the growth in actual payment volume from those accounts and on all the PayPal platforms. And here we see a similar thing where growth has been consistent, and then we get a big leap in 2020, which has continued for every quarter since then. So not only have people turned to open a PayPal account more than they ever did before for digital alternatives to transactions and things like that, but they've been allocating more of their spending to PayPal's platform, which speaks volumes about its quality and where the market is headed, and maybe that PayPal and the digital payments options are the future. Now, I'd like to show PayPal's financials, and we'll just run over those quickly and we'll demonstrate in the numbers how impressive this business actually is and how strong the tailwinds behind them have been. So you can see here every single quarter since 2014 consistently growing quarter over quarter, not just year over year. I don't think they've had one quarter where they haven't grown top line revenue, which is fantastic. This is the type of revenue chart or growth chart that you want to see with a company. Consistent top line revenue growth. Doesn't look like it's going to slow as well. If anything, this curve's starting to get steeper as time goes on and we approach the sort of $15 billion revenue mark. And actually what surprised me about PayPal is, well, I mean, they're at 21 billion of revenue as of the end of 2020. And that's not far off the likes of Visa and MasterCard, which astounded me, to be honest with you, considering how big those two companies are, how well established they are in the payments industry. So it just shows the versatility of PayPal's products and how scalable they are. And they don't think growth is done here whatsoever. And net income, we see a similar story, although it's not as consistent as the revenue growth, but it's a company that even since 2014, it's been profitable, consistently profitable. I mean, $1 billion in operating or net income, back in 2015 when it wasn't doing that much revenue. So they have really high profit margin potential. They really do. And it's jumped up this year to 4 billion from just 3 billion the year before. So they're really starting to show signs of how profitable they can be. But even with all this, it's never been a stock that has sold at a relatively cheap price. As you can see, ever since it became available to the public markets, I mean, the lowest ratio, PE ratio it was selling for was around 33 times back in 2016. So if you were lucky enough to pick it up back then, $36 per share, you'd have had close to 8x, I think that is, off the top of my head. So a very attractive return in just 4.5 years. Its price ratios have started to get more expensive as we got into 2020, probably because some of those tailwinds that we've already seen happen, but as the COVID world or new world starts to develop, should I say, those tailwinds are going to be even stronger and probably appear a lot quicker and faster than we ever could imagine. So that's probably the reason why this PE ratio or price ratio has jumped up so significantly over the past year. But they're not alone. MasterCard, Visa, it's a very similar story with them. They're always selling at a fairly big premium to the rest of the companies in the market. And that's just the nature of the fintech plays or of payment stocks. They really are those long-term compounding machines. Great economics, really high returns on capital. And the total addressable market opportunity is just huge, as we've seen. You're talking trillions of dollars. So there's no cap here whatsoever. A $20 billion revenue company is really nowhere near its limits when you're talking about the payments industry. So what I'd like to do is dissect this PE ratio of 69 times a little bit more, and I'm going to put PayPal into a valuation model, as I always do, and I'm going to forecast out the next 5 to 10 years for PayPal, get an idea of whether this price ratio is justified and if PayPal could be a good enough buy for us today, because it's one of those stocks where I'd really like to own it for the next 5 to 10 years if the price is right and the return makes sense for me. Okay, so here we are. Here's the valuation model for PayPal. We've already covered the past performance, although you can see here, healthy balance sheet, shareholder equity being built up nicely as well. Not much debt, especially relative to earnings. That's around, and free cash flow as well. Not even double free cash flow. So, a healthy balance sheet and healthy financials altogether. Now, you can see my assumptions here on the right. I've gone with some basic assumptions really in terms of matching the digital payments TAM growth and things like that. I've just gone with 20% top line up until 2025, which gets PayPal to 53 billion of revenue at that point, and then around 11 billion in free cash flow and 8 billion in earnings, right? Using all of their historic operating income margins and free cash flow. I think they can do better than a 15% margin if we take that as an example. And actually, they show this sometimes when they report earnings. They also report non-GAAP operating income, which just means that they're taking out some of the costs that they think are maybe one-off costs or that shouldn't be reported. They're trying to look at what are the cash retained or normalized earnings for PayPal. The problem is that a lot of the costs they're taking out, I think, are valid costs incurred by the company, and they're taking money out of the investors or shareholders' pockets. So I wouldn't really be happy with using that non-GAAP operating income margin. But I do appreciate definitely that PayPal can start to scale up to maybe 20 to 25% operating income or profit margins as they did in their earlier days. Now, it's interesting that these estimates here actually come out very similar and come out to very similar amounts to PayPal themselves, who gave guidance at their latest Investor Day in terms of where they want to be as a company in 2025. So they expect to generate over 40 billion of free cash flow over the period, which is really nice that they gave an indicator as to how much cash they're going to be able to put in investors' pockets, theoretically. This number here totals up to about 42 billion. So we're along the right lines there with their $40 billion guidance. And then they also expect to reach 50 billion in revenue by 2025, which I definitely think they can do. So I've come out with very similar numbers to them in that respect. If we look at my terminal values that I've got here, I've got firstly a multiple method where I've gone for a price to free cash flow multiple of 30 times, even though, relatively speaking, the market does tend to price these companies a premium above the market, above 30 usually. I've also got a perpetual growth method there, which is a rate of 3% into infinity, just to check, if our multiple is either too high or maybe too low. Just quickly though, before we look at the DCF, you can see even though it's good growth, for the next 5 years, it still doesn't eat away at that multiple that we pay as much as we would probably like it to. You're still paying 36 times 2025 expected operating income for the stock, which is a relatively big number. And if we check out the DCF then, and just based off of all those forecasts, unfortunately it does mean that PayPal looks to be overvalued, 36% overvalued going by these estimates here. Says that an intrinsic value or fair price to buy PayPal stock would have been around 187 billion for the whole company, or $157 per share, which it did actually reach back in 2020, or it was for a long period of time back in 2020. So that surge in the price that we saw last year has maybe taken PayPal up a bit too far for our liking. But there are different ways that we can look at this. So for example, I'll just show you, if we do think that PayPal can become more profitable, or it can improve its profitability, maybe with scale, or it starts to withdraw some of that spending on investments and things like that. Let's say it can reach a 25% margin, which is his non-GAAP margin at the moment, right? At the end of the period, then that means that actually PayPal could be fairly valued at the moment with a share price or intrinsic value of around $250 per share. So it really does depend on how much they can expand this bottom line income margin for me. I don't think we're going to see revenue growth for a continued period of time that's above 20%. I really think if we look at the total addressable market, the digital payments industry, how quickly is that set to expand over the next sort of 5 years? I think it will mirror that, as PayPal are the biggest player, and I think their growth will pretty much match the total addressable market growth, which is around 20%. But that being said, it is a very big market, like we've covered already. The digital payments market is expected to reach around 240 billion plus at the end of this period. So they'd be making up somewhere in the region of around 20% market share with this, which is something you could see happening and playing out for PayPal. If I was going to meet in the middle and say they can start to expand that bottom line margin, but it only gets to 20%, then it means we have a fair price for PayPal today of around $205 per share, or 240 billion for the whole company. Just looking at stock price, we did have a chance to pick up PayPal, say back in November, for below that price. So it hasn't touched, back down that low since, but maybe could. It had a sell-off obviously late in Feb, where it's dropped 23% from that high there, and it could continue dropping. You don't know. It's one of those companies that unfortunately is always going to be selling at a premium, like we saw with its PE ratio over time. But it's definitely a stock that's on my watch list. I would love to be able to pick it up if I can get it for a fair enough price. And that just about wraps up this video. So this spreadsheet will be available for anyone on the Patreon if you want to support the channel through that. I'll leave a link in the description. You'll also get access to various other valuation models that we've done on all the other companies on this channel, plus many more. So check that out if you're interested. Leave a like if you enjoyed the video. Subscribe to the channel if you haven't already. I will see you in the next one. Good luck with all of your investments.